The global markets have suffered in 2018, weakening all across the world. Central banks have taken unprecedented measures in order to backstop the losses which began in 2008. We are now a decade out from what nearly spiraled out of control, unraveling the entire financial system, and they have yet to correct the issues which took place. The risks are still very much present, and even the IMF and Janet Yellen have highlighted this point. What will the central banks do this time around as the markets collapse? You came here for the truth, so let me unveil that for you. Today we're going to look at the issues which are present in the financial system. First, I'm going to show you the BS, then you're going to get the truth. So let's start with this. The markets today are rocketing higher. The Dow Jones is up 420 points. You could see the US markets all in the green. They're doing great. And this is because the trade issues are resolved, right? This is because QE4 is on its way, right? I mean, we have something concrete, don't we? No. Dow jumps 400 points on hopes that China and the US are making progress on trade talks. Let me read that again. The Dow jumps 400 points on hopes of progress. Not even anything to any degree of progress at all. This is the type of garbage that we see every day. Now look at this. Qualcomm says Apple is still selling iPhones in China, breaching court order. This should probably make Apple stock decline. Not that significantly, but it is important, and so the stock should come down as a result. You know what's going on right now with Apple in China. This is going to be bearish for the stock, right? Absolutely not. It's in the green today, and it actually has increased in market cap quite a bit over the last couple days. Why? Why is this the case when you have problems in the company? Because algorithms trade this market, and it doesn't matter if the company's doing well or not. You have markets that are completely fraudulent, and that's what we're presented with today. So I want to show you now the actual real information, the data. That's what you came here for, not the garbage. So let's get on to it right away. Double line funds produced this set of slides, and I wanted to give you some of the ones that I found to be very informative to me. I know they're going to be as well for you. So let's get on to it right away by taking a look at this. MSCI All Country World Index and the central banks. This is something that I will continue constantly and over again to harp on because of the level of importance. And you're looking at the different central bank assets, whether it's the Fed, the ECB, and the BOJ, that's the top three, and then the All Country World Index, that's the blue line. And if I highlight that for a second here, the blue line here happens to entirely correlate with the central bank balance sheets. And I've said this hundreds of times, and I am still not being acknowledged by the mainstream whatsoever. People in the alternative haven't picked up on it. They're pointing to these obscure things, this and that, and it doesn't matter. None of it matters. All that's important today is what the central banks do. What they do affects the market. The day-to-day information is just noise, and I know I get into that too because it's relevant to people who want to hear about it. But I'm here to bring you the truth because that's why you're here. So look at this and understand, if you want to know what's going to happen to the markets, follow the central bank balance sheets. That's all you need to know. If you don't get anything else from this video, this is the key indicator. Interest rates as well, of course, but basically what the central banks are doing. So that's important. Let's get on to the next one. Global debt cross breadth, MSCI All Country World Index and local currency, looking at the debt cross and how many different countries are currently engaged in a death cross. That's the 50-day over the 200-day, and you're looking at that the percentage of the countries with the death cross at the bottom, that's the red line. We are up into levels we haven't seen since the fiasco of 2015, 2016. Obviously that was present with the sovereign debt crisis in Europe going in 2011, 2012, and of course it reached a higher level back in the financial crisis. When you have this occur, yes, it's just a simple technical indicator, but it's important because it tells us how quickly things are falling. That's another one, that technicals, that look, it doesn't matter as much as obviously something like the central bank balance sheets, but it's what the trading indicators tell us that all these algorithms are playing with. Record share of asset classes posting a negative year-to-date return. I said that right. A record amount today A record share of asset classes have posted a negative total returns this year according to Deutsche Bank data going back to 1901. It's not saying that this is the worst year ever in history. What it's saying is that you have nowhere to turn. 90% of asset classes have a negative year-to-date return. Think about what that means. 90%. There's basically nothing that you can invest in that did well this year. I want to see the portfolios of all these big hedge funds and all these big investment institutions that are telling you and showing you over the last 10 years how well their funds have been doing. But how about over the last year? Have they been positive? Probably not. So what is good right now? Well, US dollars seem to be the only thing that has some level of return this year, and that is incredible. Wherever you turn, you're looking at negative returns, and that's not a good thing for the investment institutions, that's for sure. Fed Treasury holdings versus the S&P 500. Look at what has occurred. As soon as the Federal Reserve began its quantitative tightening policy last year, 2017, here it is, the blue line. You could see what they've done, and it entirely correlates with the end of the bull market in stocks. You could see where it peaked out. Basically, in January, stocks came down after that, and they have been trading up and down ever since. But the peak, if you look at it not necessarily with the S&P 500, but as in global stocks or US stocks, it seems to be that this has coincided entirely. Now, this can rocket to new highs. There is no doubt about that in my mind. All we have to do is engage in QE4 or have other central banks around the world step up on their printing presses and make sure that it goes to new highs. That's it. You have to have the central banks bring the interest rates down all the way and engage in QE4. Now, I don't want this to happen, of course, but that's what they need to do in order to fix the problem, temporarily. S&P 500 versus the MSCI All Country World Index excluding the US. Looking at this, it shows us that what we have right now going on in between the US and all countries excluding the US is clearly a disparity. However, that gap has really closed. That gap has really closed right now throughout October into November and now December. The stock market in the United States has not performed as well as they thought it would. This tells us here on the chart that obviously all countries excluding the US is not doing good in 2018. Look at what's happening in Europe, whether it's France, whether it's Germany, whether it's Italy. Just look around. They've all had their own share of problems. Then you go ahead and look at other places like China, where the bear market right now, you look around and it's not looking good for any currency or stock market. That's what this chart shows us. Then we have this. CAPE ratios, S&P 500 versus the MSCI emerging markets. Looking at the difference here, emerging markets sitting at about 14 for their PE ratios, whereas the S&P 500 is over 30. This is historically way too high. We're being told that it's totally fine. Don't worry about it because this is the new normal. And of course it's not. Perhaps that normal of 16 on the PE ratio can get pushed up to maybe 17. Maybe it can get pushed up to 18. But to suggest that 31 is normal is a lie that they tell you. It's a lullaby to put you to sleep. After the death cross, the S&P 500 seems to be forming another scary chart pattern. This gets into the details of it, but just wanted to show you there are more patterns that are present today, including this head and shoulders pattern, which could signal a temporary market top. The pattern looks to be building just days after the S&P 500 chart flashed another scary pattern, a death cross. One strategist said in the head and shoulders forms, it could mean a sell-off down to 2,300. We'll see if that happens. I just wanted to bring it to you to show you the details of what's happening right now. This is just another technical indicator, and I like to look at the central banks and what they're doing as the primary indicator to check out, to understand, because they made the market come up in the first place. They'll make the market come down. And why in the world would a central bank want to do this? Why wouldn't they want it? Because they are the government, right? The government wants things to work properly. They want the stock market to stay up. But I have to ask you the extreme example. Why not just print quadrillions and quadrillions of dollars? Because apparently printing money doesn't cause inflation from what we're being told, okay? So print quadrillions of dollars, give it to every single person. Then you could have all your problems restored. You wouldn't have any issues to worry about, right? Of course not. That would be ridiculous. That would cause massive levels of inflation. It would completely destroy the economy. Everything would move to a standstill in no time, and there is no way to deny that. So that's the extreme example. But what the central bank is trying to do is to be a central planner, and they're trying to decide how much inflation they should create at any moment. They're trying to tell you how much of your currency that you worked hard for should be erased by their actions. And it is criminal what they do on a day-to-day basis. They make it seem as if they're helping you, but they're creating this crisis intentionally so that they can have justification to buy up all the shares. And they're going to do that next time around. They're going to buy up shares of the US markets. Every central bank is going to go out there and start to buy up all the shares of their respective countries. But the problem is that each of these central banks operates on the outside of government. They have no transparency whatsoever, and they are not acting in your best interest. They appease the shareholders, not you. If you found this video informative, please give me a thumbs up. When you give me a thumbs up, you're supporting this channel. If you like the rants, give me a thumbs up. If you hate my face, give me a thumbs down. If you hate my voice, give me a thumbs down. If you love Janet Yellen, give me a thumbs down. And that's all for this video. If you want the financial education you were not taught in school, these two books have it all. You can get all the details you need at the link in the description. I talk about everything from the foundation, the history, the asset classes, how to make money, and everything you need to know about finance, about how to manage your money in 2 books, and the total will be $30. You can't beat that because it's an education you never got in school. Check them out at the link in the description. If you want the audiobook version, you can get that at themoneygps.com.